Welcome to the Pro Ticker Deep Dive. Today we are dissecting what is, frankly, one of the most remarkable shifts in modern American finance. We are jumping into the world of property and casualty, or P&C, insurance.
Yeah.
For the better part of a century, the story of auto insurance in the U.S. was pretty much synonymous with one name, State Farm.
Right. They were the king.
Absolutely. Built on agents, local trust, brand loyalty. You knew the name.
But that reign has officially ended. That's the pivotal development here, the thing that changes the entire competitive map. Progressive, the company that built its entire identity on being different, on being the disruptive alternative, has finally unseated State Farm as the nation's #1 auto insurer.
And that's not just a minor fluctuation. That is a fundamental reversal of power. So what's our mission with this deep dive? Are we just looking at a successful company, or is this signaling something bigger?
Oh, it's about the structure. Our mission is to show you how the P&C industry is basically consolidating around a few key things: technology, risk discipline, and execution.
Not brand nostalgia.
Not brand nostalgia,
Yeah.
not history. And this is all happening right as the macro environment is shifting. We're moving from what we call a hard market,
Okay.
where, from about 2021 to early 2024, carriers could just raise premiums almost at will to cover pandemic losses and inflation. Now we're moving to a softening hard market.
So if the market's softening, what does that actually mean for competition?
It means the relief valve is being shut off. In the hard market, everyone got to raise rates. It was easy.
A rising tide lifts all boats.
Exactly. Now, competition is going to get intense. Rate relief is coming for consumers, which is good for them, but it forces carriers to be ruthless about operational efficiency. If you can't underwrite risk with absolute precision and you can't manage your expenses, you are going to bleed market share and profit.
And Progressive was built for this.
They were built for this environment. And State Farm, well, they proved they were not.
Okay, let's unpack that moment, the precise moment Progressive took the top spot. The numbers themselves tell a really clear story here.
They do.
What does the 2024 scorecard actually look like?
So Progressive now holds the #1 spot in U.S. auto insurance. They have 16.4% market share.
Okay.
That's based on about $70.84 billion in direct premiums written in 2024. And State Farm is right behind them at 16.2%.
So it's a slim margin, but at that scale?
At that scale, the symbolic and financial victory is just massive for Progressive.
And this is the key, right? It isn't just about growth. It's about profitable growth. That's where Progressive really separated from the pack.
Exactly. Look at this. Progressive's net premiums written grew by a phenomenal 22.2% year over year.
Wow.
But here's the crucial metric, the one that matters most. They did that while maintaining an industry-leading combined ratio of 88.8%.
Okay, for anyone just diving in, let's define that. The combined ratio it's everything in this industry. Why is 88.8% the gold standard?
The combined ratio is the purest benchmark of underwriting discipline. It's basically the money you spend on claims plus the cost of running the business, all divided by the premiums you collected.
So anything under 100, you're making money just on the insurance itself.
You're profitable on underwriting alone before you even touch your investment returns. And at 88.8%, Progressive is incredibly disciplined. To put that in perspective, their net income more than doubled. It went to $8.46 billion in 2024.
From what?
Up from $3.9 billion the year before. That is generational wealth creation fueled by operational precision.
Okay, now lay that next to State Farm, the company that was supposed to be the rock.
The contrast, it couldn't be starker.
Yeah.
So State Farm technically reported overall net income of $5.3 billion, a recovery, from that catastrophic $6.3 billion loss they had in 2023.
Right.
But, and this is a huge but, if you strip out their investment gains and you look purely at their core P&C insurance operations, they posted an underwriting loss of $6.1 billion.
Wait. They lost $6.1 billion on their core business, but still reported a profit of over $5 billion. How did that math even work?
Legacy assets, it's the power of their massive reserve portfolio generating huge investment income. But here's the fundamental problem. Their P&C combined ratio was around 104%.
So for every dollar they took in, they paid out $1.04.
Exactly. They are structurally losing money on the business they're actually supposed to be in. They're surviving entirely on their investment portfolio. That is just not a sustainable competitive model long term.
That is the perfect illustration of execution versus just historical wealth. So let's pull back to the macro forces. What's driving this inflection point right now?
You've got two tectonic plates moving at the same time. We've talked about the softening market, which amps up price competition. The second major factor is the climate elephant in the room.
And we're not just talking about floods and fires, right? This is about a fundamental shift in risk aversion.
Absolutely. Elevated catastrophe activity is forcing these huge strategic retreats. We're seeing insurability itself become a bottleneck. I mean, State Farm famously just pulled 70,000 homeowners policies in California.
Right. And Progressive did something similar.
They halted renewals for 100,000 coastal properties in Florida. These are not minor tweaks. These are multi-billion-dollar decisions to just shed risk.
So if the private carriers are just walking away from these entire regions, where? Where does that risk go?
It doesn't disappear. It gets pushed onto the public sector. The exposure moves to undercapitalized government-backed programs like state-run FAIR plans or the National Flood Insurance Program.
So the taxpayer becomes the insurer of last resort.
Essentially, yes. The private market is offloading its riskiest customers, and it favors the companies that can exit the fastest.
And alongside climate, you mentioned distribution is fragmenting. This is challenging that old agent model.
Correct. The old model where you rely on a huge, expensive network of exclusive agents, that's the State Farm model, is under extreme pressure. Direct distribution, online, phone, that's gaining ground.
But there's another force too, right? The MGAs?
Yes, managing general agents. This is a major new force.
So what are they and why are they so disruptive?
Think of them as specialized insurance wholesalers. They handle everything from binding policies to claims, even underwriting for big carriers. They are digitally nimble, they specialize in niche risks, and they use cutting-edge tech.
Which gives them an edge over the old face-to-face model.
A huge edge. It favors carriers like Progressive that can integrate with their tech seamlessly.
This is where it gets really interesting for me.
Yeah.
What is the Progressive playbook? What specific operational advantages allowed them to get that 22% growth and that incredible sub-90 combined ratio?
Okay, so their playbook really rests on 3 pillars, and they're all connected by technology. First, relentless disciplined growth. That 21% net premium growth in 2024 was the highest among the top 5, and they did it with the best combined ratio.
And you said earlier, every percentage point of that ratio is worth, what was it, hundreds of millions?
At their scale, every single point of improvement in the combined ratio is worth about $700 to $800 million in profitability. So if State Farm is at 104% and Progressive is at 88.8%.
That's a 15-point gap.
That 15-point gap translates to a competitive moat measured in the tens of billions of dollars. That's what technology unlocks.
Staggering. So the second pillar has to be that tech-driven cost advantage.
Absolutely. This is their structural moat. Their direct channels, online, mobile, the Snapshot Telematics program, create a cost advantage that the agent model just cannot compete with.
So when they increase their media spend, what was it, 150% last year?
Yes, but it was hyper efficient. They use AI for this incredibly granular precision underwriting. They can pinpoint the most profitable customers and target them directly.
So it wasn't just more flow commercials. It was smarter spending because they knew exactly who would give them that 88% ratio.
Precisely. And pillar 3 is strategic de-risking. This ties back to the climate conversation. They actively cut their homeowners book and just exited unprofitable zip codes all through 2024.
So they're sacrificing some market share to protect the overall bottom line.
Exactly. They finished the year with a property combined ratio of 98.3%. It's tight, but it shows they are strategically retreating ahead of predicted catastrophe spikes.
Despite all this, we did see their stock pull back.
We did. It's not immune. It pulled back about 23% from its peak in March of this year, from around $293 down to about $225.
And that's just a valuation reset.
I think so. When you achieve this kind of dominance, investors start pricing in perfection. So any market volatility, any sign of growth moderation, it triggers a repricing. The stock's still in a powerful long-term uptrend, though.
Okay, let's pivot to State Farm. It's a mutual giant. It has that policyholder loyalty. What is preventing them from adapting?
The first thing is just the sheer size of the underwriting losses. Their auto business, 104% combined ratio in 2024. They tried to fix it by taking huge rate increases, 10-15%, but it wasn't enough to keep up with loss inflation.
What's driving that inflation so hard?
A couple of things. First, repair costs. You know, modern cars are just computers on wheels. They're full of expensive sensors, so even a fender bender costs a fortune to fix.
Right.
But the second, more insidious thing is what we call social inflation.
Okay, let's define that. That's a key piece of jargon.
It is. Social inflation is basically the rising cost of claims because of societal trends. It's about rising litigation costs, but mostly it's about massive jury awards in liability cases.
So juries are just awarding bigger settlements than they used to.
Far bigger. And that gets priced into the loss ratio immediately. And the crisis for them in homeowners is even worse than in auto.
Really?
Oh, it is deeply problematic. They earned $34.5 billion in homeowners premiums, but lost $3.5 billion on underwriting. That's a combined ratio of around 110%. They underpriced that risk for years.
Beyond the losses, it seems like the mutual structure itself is the real hurdle.
That is the ultimate bottleneck. They're owned by policyholders, not shareholders. That means they can't just go to the equity markets to raise capital for a massive tech overhaul.
And it makes them slower.
Inherently slower. Decisions about huge capital spending, big strategic pivots, it all has to be balanced against policyholder dividends. They just lack the agility of a publicly traded firm that's driven by quarterly demands.
And their biggest asset, that 18,000 agent network, is starting to look like a liability.
It's a huge liability. It's incredibly costly to maintain, and you're seeing a wave of retirements. If agent productivity drops or they start defecting to competitors, State Farm's moat just evaporates.
Okay, so if this duopoly is breaking down, what does it mean for everyone else? How do Geico and Allstate fit in?
The thesis here is that the future favors either specialists or companies with overwhelming scale and efficiency. So if we look at the others, Geico, at about 10.3% market share, they actually hit the brakes on growth intentionally. They were growing too fast, sacrificing quality, so they slowed way down to fix their underwriting. Their growth is anemic now.
And Allstate.
Allstate at 8.6% is similar to State Farm with legacy costs, but they've been much more aggressive about pruning unprofitable business. They've shown they're willing to walk away from high-risk zones.
Then you have USAA.
USAA at 5.1% has that incredibly defensible niche with military families, but their growth is, by definition, limited.
And this consolidation thesis points to M&A as the next big phase. Who wins that game?
Progressive is perfectly positioned. They have the capital, the discipline, the culture. They could easily acquire smaller specialty carriers. State Farm, because of the mutual structure, is just not likely to be a big acquirer. The future favors efficiency and specialization. Progressive has been playing that game for years.
Let's synthesize this. Progressive is winning. State Farm has the scale to survive, but it's bleeding. Where do we go from here? What's the investor outlook?
For Progressive, the bull case is clear. Their tech moat and efficiency should let them keep growing profitably, even in a softer market. They can keep that combined ratio below 90%.
And the bear case has to be that they're priced for perfection.
Exactly. Valuation sensitivity is the biggest risk. The market expects them to be flawless. If catastrophes spike next year or inflation gets worse and their combined ratio slips to, say, 92% or 95%,
The market will punish them.
severely. They have a higher hurdle than anyone else.
And for State Farm, don't expect a triumphant comeback.
I would expect continued muddle. You'll see small underwriting improvements as those rate hikes finally earn in, but growth will slow, margins will stay under pressure. They're not going to reclaim dominance, they just lack the agility.
This whole deep dive has been a masterclass in how data can beat legacy. But the most provocative thought you left us with is about the consumer, that risk avoidance is the new business model.
It's the ultimate implication of all these numbers. The industry has decided it's more profitable to avoid risk than to price it. So you see these giants just exiting high-risk zones.
Which creates an insurance crisis for people in those areas.
It makes insurability itself a crisis for whole regions. And when the private market backs away, the state and the taxpayer become the insurer of last resort. And long-term,
Right.
that is an unsustainable way to absorb catastrophic climate risk. It is the highest cost of this entire consolidation.
A tough reality hiding inside those combined ratio figures. See you all in the next ProTicker Deep Dive.